Hey guys, this is Julie. Had a chance to chat briefly with someone who is very much involved in the markets with the macro, and he was saying briefly that ranges, pivot point, support resistance levels, these are all calculated due to a previous open, high, low, or close to achieve their realized or expected volatilities. And if one level breaks or tests the next possible line, that may break as well. And he thinks that's random and a normal behavior. One standard deviation may hold, but if more momentum comes into the market, obviously it may test the second standard deviation or third, or even go outside the distribution. And they rely on macro instead of these technicals because they're not sure whether the distribution will hold at a particular level or move to the two or the three. And I don't think he really put any thought into this and how the higher time frames, if it breaks a daily 1, 2, 3, is it trying to get over here to a weekly one or a monthly one? You know, where these levels line up against each other. So it's true that a lot of people will run their models based, on these bell curve or whatever their Black Scholes models that they're trying to, you know, get support resistance levels from. My model, of course, is proprietary, and I do think it provides significant value because my levels are so good. I mean, I see this every single day where, meaning what define good, my levels will actually show where support resistance comes into the market. Here's the daily ES, for instance, could not get past the PT3, my third standard deviation, on Friday, despite several attempts. And they were coming at it full force. I mean, with all the red, red, red on the market analyzer momentum. If the market is not going to move any further at that point, wouldn't you want to know this information? And why wouldn't it go to a higher time frame like a weekly or a monthly? Well, I'm able to put these, distributions on my chart and see where these higher time frame levels come in. And let me show you this. Come into the market and how the market responds to these higher time frame levels. But more importantly, I was tweeting on Friday that this VIX, even though the contract expired this week, it held the level, the 30-day one, which is where the dealer support is. They had their put wall there, and that's why the vol crushers could not go any further. But it tried for the, you know, after the VIX, um, you know, came and went, they still tried to break that level lower and they couldn't because the dealer is still using that 30-day one because the 30-day one's right here. So if you knew that the volatility could not continue lower, um, then you would assume that it would start rising from there. And that's why the market tried to take off, right? If the volatility is not going to go down, it's got to go up, right? So the market took off finally, trying to, break these ranges, but it could not get past the daily three. And it got stuck. And as you can see, it went right to my level. These levels are not back painted. These are the levels that they are. And I get what he's saying. If you break a 1, 2, 3, how do you know that it's going to, land or stick on that line or go to another higher time frame? So there is a sort of art to this where you you look to see if there is other support resistance maybe blocking it. And you can see on these higher time frames that there's significant support resistance on these monthly levels at the same location that you had a daily 3. So you had a daily 3 at 43.83 sitting there on a monthly 123, right? A monthly 1. So if you know about the 123s on that bell curve, then you can appreciate that most of the risk is going to be sitting on these ones for these higher time frames, 68% of the time. And if the dealer has their put and call wall right here most of the time on these higher time frame, like the monthly and quarterly, that is significant support resistance. So when that is combined with a daily 123, then you're able to really start putting these pieces together and say, this is going to be valid support or resistance, and, make, a more educated guess based on these probability distributions. And I just think having the support resistance levels is something that everyone would want to have, because it provides such great um, information for us. So the levels are dynamic, they're not static, they will change. And as the distribution changes, the bank, the dealer, will move their risk accordingly with the level. So something like that. So we can see the flow of the market as it, breaks a weekly level, comes up, comes back to test it, and then tests it again and takes off and goes right to the weekly 3, target 123. Um, there is a statistical framework in this market. I don't think it's random, is what I'm trying to say. I think that the market knows exactly where the support resistance levels are and trades to these. And I think that my distribution is pretty pretty amazing to catch the actual support resistance in the market. And I can do this on all time frames. Here's the Globex distribution on the ES. That is, and with daily 3s. This is your daily 3 inside of a Globex. So there was a Globex 1, 2, 3 sitting here, targets below, but they could not get past the daily 3. They had it locked down like Fort Knox, and I said that. So you can put these on any time frame. Here's a distribution for the RTH period. And another thing to be aware of is you can put these distributions if you trade options on higher time frames, like run some 3s and put them inside these levels where your puts and calls don't get hit, or see that a side is being challenged and decide what to do on a lower time frame as far as like a daily 123 to move the risk temporarily if it's getting challenged or close the position. But often you'll see that the market protects these levels because that's how it operates. You've got pension funds and government funds and sovereign wealth funds. Everybody is, trading inside these ranges. So once you're able to put your self inside the range and can measure it, then you can really start doing things with it, right? Then you can say, well, I'm inside, um, you know, a monthly range or a daily range or a weekly range, and this is where I can get um, an order off of. So if you were bullish, Obviously the best place to buy is that one, right? Especially when it's tested. And um, if you're bearish, likewise, you're going to want to sell the ones if it's coming down. We've been bullish since March, or most of this year, since, March, April, March, right here, when the banks started getting their funding, March 12th, I think it was. Right here, it started taking off. So this right here, they funded the banks. So here was the first test of a lower one. I mean, whoever was buying these ones down here, I mean, my gosh, they knew what, the Fed is, supporting the banks. No more banks will fail. Every dip is being bought now in the S&P 500 for good reason. I mean, the market's going higher. And everybody's telling you that the market's going higher, but we will get a little bit of a correction. But that means each correction is going to be looked at, as an opportunity. So, have an idea of where these higher time frame ones are. So if we're in a correction, it means that they're coming down for a higher time frame, right? So they're coming, what would your lower one be? It would be like 43.62, or let me put the quarterly back up here, the monthly, I mean, 43.62. Yep, 43.62. So I would be looking, at 43.62 as a location to see, the activity coming back in. But we know that 43.20 is a quarterly on SPX. Um, so we have to, have an understanding of how the market actually works also. And let me put up an SPX chart real quick. Oops. Hang on a second. I tried to click something too quickly. Let me cancel that. Let me just change this to the SPX. And we need to see where 43.20 is on the SPX. And realize that by next Friday, next week, there is a really good chance that the market is going to be 1 point or more below 43.20 um, at some point on Friday so that they can roll it. So here's the SPX, and you can see how they come in at the ones. You see where they find these ones. So here, 43.05. There's your bounce box. So it will hit 43.20, go through it, and they're going to roll their position. I would, give me a magic 8 ball, right? Shake it up. They're going to roll their position between 43.20 and 43.05. Yep. So they've got on June 30th. This is the SPX. This is different than the ES. So the ES monthly one is different. So 43.05, 43.20 on the SPX is going to be the equivalent of that monthly one right here, 43.62. So I would say that we're going to have a flat week, you know, or it could go much lower. Um, it could break the monthly one and come down further. If that happens, then that short term or this long term uptrend is going to be into a correction. And then we would want to look at our other levels, 1, 2, 3 month in particular, and see if we can find some mid ranges to trade to. So if I were to fib this in a mid range, here we go, something like 42.34, 42.50. I'd be looking, if it does break these ones and comes in lower for that correction, that's what I would be looking for. Otherwise, I would be looking for that 43.20 to 43.05 SPX to bounce if they're going to continue the market rally and go, continue going vertical. But I mean, at some point, the market does have to pull back. But all we have to do is follow the VIX. So what I like to do is measure my fibs on the VIX and look for these um, midpoints, and the market will either, be in the midpoint area or on the edge on each expiration. So in July, we can either be at around 19 or around 15, 16 or 22, 21.92, 22. So, but I think we'll be back inside the 23 day. So I have 23 day, 30 day, and 37 day for my distribution for the VIX, and I do that because they use those time periods for their expiration calculation, and the distribution works perfectly. That 30 day, um, as you can see with your eyeballs, the eyeball test, it works. So let's look at crude real quick, and I won't keep you forever. I just, wanted to respond to my new BFF that's a macro trader and let him know that, the macro doesn't work. Because if you used macro, every fiber in your being would have been shorting this market a long time ago. And there's plenty of people who um, got um, into trouble for trying to short from the macro because the QE, the bank facilities, were propping up the market. It's in um, hyper state. It's a QE state. So you got to trade with that. Right now, crude is flat. Do you see how it came down to the monthly one? That was a monthly one. 3 month, quarterly one. Bounced on the quarterly one. It's like flipping a dime off of a curb. And it may eventually try to get down to these lower ones or, back up, but you're trading inside the mainly the white zone most of the time. And when it comes out of the whites, that's my ones, it tries to get down to the twos and or threes. If it leaves the one, where does it go? It goes to the two. Um, Not rocket science. So like right here, went to the one, went to the two. Here we broke the one, got to the two. Ones and twos really work. It doesn't always get to the three, but if you just learn to trade 1 to 2, 1, 2, 3 on these various time frames, that alone should be able to help you with your other macro and your other analysis. Then you can put your other, technical analysis, volume, or whatever else you like to do. Um, the volume ladder, volume profile, however else you like to make your, determinations. If you like a 200 moving average or, whatever else you like to trade, you can add that with the knowledge of where the um, support resistance is based on the JATS model, uh, might help you. So if you have a football field and you know where the out of bounds are, and if they break a level with high momentum, then yeah, take it to the profit target. Likewise, you can be in the middle of the range and see that it's heading to one side or the other. You can trade to these targets, trade to the 1, 2, 3. That's what I did when I first built my model. Is I wanted to trade a 15-minute time frame. Here's the nat gas. You can see it broke out of the one. It broke the one, but it did not get to the three. Look at this. The daily three held it. It broke the, it's interesting, the 7-day one, but it did not break the daily three. So you can see that the gas traders are using a combination of the 7-day and 7-day one and the daily three. And here's your 30-day larger um, football field that the 7-day and the 1 day are going to be trading inside of. But I was just trying to get a 15-minute time frame, right? So when I built my model, it was built on a much smaller playing field. And I noticed after building my model that it worked for all time frames. So I would, let me put a 1 minute chart on it, and I will show you what I was doing. So I would try to get from the RTH open to the 1 on a 15-minute time frame. So I would go from 8:30 to 8:45. I think I have it 3 instead of 8. All right. And that's not a, hang on. There we go. 8:30 to 8:45. And here's the lines. So between 8:30 and 8:45, right here, this is where it opened. And you can see the open is right in the middle of my distribution. So if I were to take the distribution from the high to the low, you can see that's right where the open is. Right? The bar opened. And it got to the 1, right? First target reached, 15 minutes. Got to the 2, and it got to the 3. So there's my 15-minute 1, 2, 3. That's what I was trying to achieve when I built this. It's like, how far do I know to go, right? We don't. Nobody knows, right? How far can we take it? Where can we expect it to go? They tried breaking it out, and it turned around, right? Came back in, found the mean again, tried to break out a second time, failed, came back down. So that's how this works. Um, and if you do get a breakout of this 15-minute range, then you're trading to higher time frames, right? You're no longer on a 15-minute range. You can put a 60-minute range on top of it. So we can come back in and put a 60-minute range on top of the 15-minute range. So don't choose day. Don't choose fibs. Choose 8:30 to 9:30. And then I will add a fib. But here, so it went right to the 60-minute 3, right? So it left the 15-minute 3 and it went to the 60-minute. So if I were to fib again this 60-minute 3, you're going to see that it, oops, wrong one. I'm always grabbing the wrong thing. Fibonacci. You're going to see it's the same middle, right? Same mean, 8:30 to 9:30. But now I just have my, where's it going to go in that first hour? Target reached. Can I go to the 1, 2, 3 on the 1 hour time frame? And you can see it went right to our standard deviation, plays inside the standard deviation levels. So can I hit the target? And that's another thing. This was set up to hit the target, my model. I want to hit the line. I'm not trying to not hit the line. So, you could, I could redo my calcs a little bit so that you could offset this with, selling puts and calls. Um, and you can do that by using the fibs. So 0.5, let me do this right. 1, 1.5, and 2. 0.5, 1, 1.5, and 2. And let me just make sure all of these are these now will measure actual distances of the distribution. So if we measure with the ruler from the 3 to this, you will see that it's the distance to the mean to the 3. Do you see that? So I can put us in 1-to-1 ratios of the actual distribution. And it's 0.5 because we're only using half the distribution. If we were to measure the full distribution, that would be 1, right? And there's your 1 up there. So you can use this to put your puts and calls if you don't want the line to be hit. You know what I mean? If you want to sell a call or sell a put for your DTE, your 0 DTE, this is a great indicator for you because you can see where it might actually not hit. You know what I'm saying? And you can go back and you can see how it gets to the end of the road and turns around, right? It didn't even get up to the last one. But it goes to the statistical base. Look how it catches the support resistance. So this is why I built it to begin with, was just to be able to day trade it off of the opening range, just like we all do, opening range breakouts, and get levels. So I've always known that my levels are good. I was looking around at other people who were good, who I chose as I thought that they were good, to see if I could work with them because they offered something like volume or another confirmation. But then I realized, my levels on their own, and that's what somebody said is, it's just not about the statistics, and I disagree. I think it is. But if you have confirmation, like with volume or something on these levels, then that's when you know that it's not going to go, as my other new macro friend was saying, how do I know that it's not going to go up to the next higher level? How do I know that it's going to flatten out or that's going to be it? Well, that's why I was looking around for other confirmation, like with volume and stuff like that. But having just the benefit of knowing where these monthly, 1 month, 2 month, 3 month levels are in relationship to the opening range levels, I can often see that a daily one or a weekly one, which get hit all the time, a weekly one in particular. I love being able to tweet out weekly one because I know that that's going to be a pretty strong, level to lean on intraday. If it breaks out a little bit, it's probably reaching for, that higher time frame level. That's what I'm trying to say. But so you don't really need the volume to back you up because you already know what the market is going to do most of the time, or a good, probability. All we have are probabilities to lean on. Um, so here it broke out a little bit, and if I were to put a daily or weekly underneath it, you would likely to see that higher time frame being down there that it was trying to tag, and then it took off and it went right to the three. Look at that. So again, these are not levels that I back paint. This is just using my model, like all the other funds do, to come up with my support resistance lines. And so I can go from the smallest 15-minute range and 60-minute range to higher time frame, daily, monthly, weekly, quarterly, or custom distribution like you saw me do with the VIX. I don't have that on this chart, but yeah, keep yourself open. If you would like a 45-day distribution to, start your, strangles or whatever, short strangles, or I like call spreads and put spreads better because I think you make more. But so especially with DTE, if you're trading the zero DTEs, this would be fantastic because then you could come in with your quick strike, right? And get your distribution set up. I'll just put one on here real quick. Go to quick strike, log in, and then look for what your levels are going to be for that next trade session. Right here is Monday. I like looking at the calcs on the settlement. You can choose different models. Black 76 works with the futures. I just am a stickler for that Black Scholes. And so you can see where your 1, 2, 3s are, and they're, buying and, you know, selling these out of money. Um, Puts and calls coming back in, or, buying these calls and going out. But if you have the JATS PT with this, you could really come up with a fantastic strategy because you know where these um, realized volatility uh, expected ranges are, and you can match that then with your implied volatility, and come up with a game plan of where to park your puts and calls. I have found that JATS PT gets you in closer so that you keep more money and you don't have to go as far out as the implied vol. But that's something that you can play around with once you get the indicator. We're having a sale right now, so bear with me when I show you how to find us. Come over to the website. Oops, wrong one. Always clicking the wrong one. Here it is. So come over to the PT price oscillator, PT and price oscillator. Um, you get the indicators so that you can see Um, the realized volatility levels, the one, two, threes, you can set it up any color coding that you like. And if you're doing a plan to keep it inside the range, you can see how well that works out a lot of the time. And we're having a sale. If you purchase now through July 4th, you get the special offer price of $175 a month that you can lock in as long as you don't cancel the subscription for up to 1 year. We will increase the price after July 4th, and that normal price is $250 a month. So there is a $75 a month, or there is a savings. Is that 75? Yep. So definitely worth considering, and add that to your toolbox. And again, just for 1 month, if you are just wanting to check it out, see if it helps you, it's worth. You can cancel the subscription at any time. You're not locked in for a 12-month subscription. It's something that you can cancel. So definitely, I just wanted to explain that I was really looking for the short-term day trading aspect to it, and then quickly realized once I had built it how amazing it truly, truly is to hit these higher time frame quarterly, monthly, weekly levels, as well as the daily and Globex for that matter. Globex is a fantastic distribution to use, and I like putting the daily one, two, threes on it as well. But I'll tweet out all the time, Globex three, because you can't break a rank. You can't get a trade trend going without breaking the Globex 3. That will be the last line. If it does trend, if you do get a trend condition and a breakout, that Globex 3 has to be broken. So that's why like looking at the Globex 3 so much. Um, or it's going to turn around on the Globex 3. Here it came right to the Globex 3 and Globex 1 and bounced. I mean, you'll get, some amazing, amazing opportunities here looking at these at levels, I think, and then incorporate them with, your other technical analysis or volume indicators. Um, just putting volume on the chart with this can sometimes give you an amazing um, light bulb moment. So if I were to, I think I have a color volume. I think here it is, volume colors. So, you know, I think I like this top one. Okay. So you can see whether the volume is going down or up. Up is white, down is red. And you match that with your price action, and then you get a white bar at a support resistance level for that volume, hitting that support resistance level. I don't know if you can see this. Volume works really well with my system, and that's why I was so hoping to find somebody who was an expert in volume and work with me. But I think just matching the two together would provide a great opportunity to provide some comprehensive technical analysis to be able to make a decision on whether to enter at these support resistance levels with confirmation of volume. There we go. All right. Thank you so much. Hope to see you. We have training once a week and get you set up, help answer any questions. This also includes the Ninja Web now, so I can show you that, where all you need to do is log into your account online. You don't have to download the software, um, and be able to put up a distribution on the fly from any internet connection. So it works with NinjaTrader Web or Tradeovate Web. And so you can come in here and you can see the daily 3 also as a support resistance level. All right. So Ninja Web, NinjaTrader 8, and Tradeovate are the 3 platforms this currently supports. And one price will get you all 3 platforms. If you only use the Ninja Web, then that's fine. If you would like, if you have the NinjaTrader 8 platform, um, that is good as well, or even better, because you get the additional analytics of the market analyzer. So you could, put on a market analyzer where your weekly, daily, monthly levels are, so you can look at it, on a market analyzer instead of having a bunch of charts up. But the Ninja Web is fantastic because you get to log in from anywhere, right? You can be on vacation and not just go to Tradeovate, but actually have a distribution and have an idea of where you are relative to a daily range. All right, thank you so much. I've gone on a little bit longer than I wanted to for this. I'm going to get better at these recordings and make them more succinct so that I can get to a point in and out. But I really wanted to show you why I think this is such a fantastic indicator, and it goes, against macro. I mean, we really have to take our head out of the macro at this point because we're so distorted in the market with this QE. Thank you guys. We'll talk to you later.